Financial supplies are input taxed under GST law. This broadly means that they are not subject to GST, and input tax credits cannot generally be claimed on costs incurred with their supply. Financial supplies are, in general, services provided by banks and other financial institutions. The GST regulations specify a list of what items are regarded as financial supplies. The regulations also list supplies that are specifically not regarded as financial supplies. BNT Limited is a bank providing a variety of services to customers, including money lending, taking deposits, and selling general insurance. It therefore offers supplies that are financial supplies, such as lending funds and taking deposits, as well as supplies that are not financial supplies, such as general insurance. BNT's financial supplies are not taxable supplies, and so no GST is levied, and generally no input tax credits are available on acquisitions relating to these supplies. As a result, it needs to apportion its costs between these two activities in order to calculate its GST liability and input tax credit entitlements. This brings up the issue of how to apportion costs between these activities. For instance, BNT wants to know the input tax credits it can claim on items such as cost of computers and costs of heating its offices. According to the ATO, the direct estimation method should be used where possible. The ATO is flexible about how this method is applied, as long as the methodology is fair and reasonable. For example, BNT might be able to specify which computers it purchased that are exclusively used for the bank lending business, and which are used for general insurance. BNT finds that its remaining 200 computers are, on reasonable estimate, used 70% for bank lending and 30% for general insurance. Overall, the apportionment of computer costs between financial supplies and non-financial supplies is split 85 to 15, meaning that input tax credits can be claimed on 15% of its computer costs. For the direct estimation method, the ATO will accept an apportionment that is consistent with the accounts of the taxpayer, as long as such accounts are consistent with accounting standards. For some costs, the direct estimation method is not possible, and so the ATO will accept the use of an indirect estimation method. For example, in determining what extent it can claim input tax credits on the electricity for heating its offices, BNT can make an apportionment based on revenue percentage, direct cost, or some other reasonable method. Using revenue percentage, BNT calculates that 10% of its electricity for heating is used for general insurance and 90% for money lending activities, meaning that input tax credits could be claimed on 10% of its heating costs. CD Limited is a car dealer that sells cars and offers finance to some of its customers. Although lending money is a financial supply, it would like to know if there is a way it can claim input tax credits for all its acquisitions, including ones related to offering finance. For administrative simplicity, enterprises are able to claim input tax credits on acquisitions relating to financial supplies if they do not exceed the financial acquisitions threshold. The financial acquisitions threshold is calculated for a test period. When this threshold test is applied, it is assumed that input tax credits on financial supplies are available. The threshold is exceeded where the total input tax credits on financial supplies for the test period either exceed $150,000 or 10% of all potential input tax credits. The test period for applying this threshold includes both the current year and the future year. The current year covers the previous 11 months and the current month. The future year includes the current month and 11 future months. CD Limited makes $99,000 of GST-inclusive acquisitions relating to its money lending or finance activities in the current year and $88,000 in the future year. CD Limited makes total GST-inclusive acquisitions of about $1.1 million for both the current and future year. This means that it has not exceeded the financial acquisitions threshold for both the current and future year. As a result, CD Limited can claim input tax credits for all its activities, including its acquisitions relating to financial supplies. Lion Limited is a finance company whose sole business is lending money. Lion Limited lends to customers that other banks might not lend to. Lion exceeds the financial acquisitions threshold and has recently outsourced its loan approval process to a commercial private lender. Can Lion claim any input tax credit for payments to the third-party loan approver regarding Lion's provision of financial services? As a general rule, for entities that have exceeded the financial acquisitions threshold, an input tax credit is unavailable for acquisitions related to making financial supplies. Despite this general rule, a partial input tax credit is available in limited situations. Specifically, where the acquisition in such a situation relates to certain transactions, then there is a reduced entitlement to 75% of the input tax credits. Lion can claim a 75% input tax credit for the loan application services they pay for, given it is an activity that a reduced input tax credit is available for. To recap, taxpayers cannot generally claim input tax credits from acquisitions relating to financial supplies. Taxpayers providing both financial supplies and non-financial supplies need to apportion their acquisition costs between the different supplies using either a direct estimation method or an indirect estimation method. An exception to the primary rule applies when the financial acquisitions threshold is not breached. And in certain cases, a reduced input tax credit is still available for some specified activities, such as loan services.